just a fact of life. Anybody who does webinars with me knows this is, I'm literally, all the windows are closed. This is not windows open. I'm on the 11th floor, and this is what it sounds like all the time in New York City. So I ask you for indulgence in this, but that is just New York. Everybody who trades with me is already familiar with the sirens. Okay, hopefully they won't bother us too much. If they get too loud, I'll just shut up and then I'll let them pass and then I'll go by. That was, I think, an ambulance. We get so good we know the difference between the fire siren and the ambulance siren. That's the true key to being a New Yorker. All right, I'm ready to go. Do you want to hit the record button, Fabian?
Sure, good to go.
Okay, all right, super. All right, guys. Hi, everybody. This is Boris Schlossberg with BK Forex and Pepperstone. And today's very, very special webinar is all about mastering risk management techniques. In fact, I would say incontrovertibly, undoubtedly, indubitably, whatever superlative you want to use, this is by far the single most important webinar I will ever give. As a matter of fact, when Pepperstone came and asked me what kind of blurb I wanted to write for this webinar, I literally wrote, the most important webinar you will ever attend. And I really wasn't being hyperbolic. I am not in any way, shape, or form unserious about this. I literally believe that everything that I've put into this webinar is probably far, far more important than anything else you ever learn about trading. And that's, I think it'll become evident as we go forward. But before we start, as always, past performance is not indicative of future results. Trading Forex, of course, carries a high level of risk and may not be suitable for all investors. And I ask for your disclaimer very carefully to understand all the risks associated with trading and margin. The seek advice from an independent financial advisor if you have any doubts. I mean, this disclaimer could not be more appropriate for the content that we're going to talk about today, because it is literally all about risk. But before we get to risk, let's talk about one very important point, which is that contrary to popular belief and all the 5 million gurus out there, including yours truly, who love to tell you that there's a million different trading strategies and that there's 100 different ways to optimize and create the perfect entry and the perfect exit and do a whole bunch of things, there are literally only 2 trading strategies in the world. That means you, I, Jim Simmons from Renaissance Technologies, George Soros, and everybody else essentially trades only 2 things. There are literally just 2 things that the market does, which is trend, or the belief that whatever happened in the past will continue in the future, or range, which is the belief that whatever happened in the past will actually reverse and go the other way. Every single strategy, whether it be on a microsecond or a multi-year strategy, is essentially built on one or the underlying foundation. Everything we do is just derivative of these 2 strategies. As a matter of fact, in the BK chat room, I have 2 algos, 2 EAs. One is called trendy, one is called choppy. And that is literally all I trade. I have just completely distilled myself to those 2 disciplines, and it's been extraordinarily clear and efficient and very, very effective to do just that. So don't be fooled with 100 different if-then statements and variations and all sorts of nice little things, including, from me as well, of all these cute little strategies that everybody pushes at you. There's literally nothing except trend or range. Your only decision is price going to continue or is price going to reverse? Every time you make a trade, that is the only question you are trying to answer. So that's why. That's it. Everything else is just simply commentary. There's literally nothing else under the sun. Once you begin to realize that, it becomes quite important and quite obvious that risk control is always the differentiating factor in winning at trading. That every great trader is not a great trend trader, is not a great counter trend trader, is not a great value investor, is not a great momentum investor. Every great trader is simply a great risk manager. Because it doesn't matter what they do. They can do, oh, I'm so dyslexic that sometimes I think I misspell everything. I thought I put 3 N's into winning over here. But everything that anybody does is really a mode of risk. And within risk, there's actually a dichotomy as well. There are effectively 2 risk models that exist in the world. I mean, there are sort of more, but the gradations, the primary risk models are these 2 that I want to talk to you about. So the first model is called, I call it the Lotto Model. I mean, these are my own terms, but I think you understand that it's essentially a description of one or the other concepts. But the Lotto Model is pretty self-explanatory, and the other model is called the insurance model. The Lotto Model is used by venture capital firms. Essentially is the model of stock indices, is essentially a model of trend traders, and in quite many ways is the model of conventional trading gurus. The Lotto Model basically says, bet a little, win a lot, right? Make a small risk bet and try to go for a large risk win. Venture capital firms have a failure rate of like 98%. So 98% of trades that they make fail. But just 2 of them can pay for the rest of the losers. One of the most interesting things about stock index investing, and one of the sort of more fascinating pieces of research that's come out very recently, is that the reason why passive investing, why just buying the stock index almost always works better than trying to pick your own stocks, is not because the stock index itself is brilliant, but because basically within the stock index, something like 20% of all stocks are responsible for all the gains. And within the 20%, there's like only 5% that are responsible for literally 95% of all stock market gains. So what that means is that 80% of all stocks are not just flat or small gains. They're actually losers, right? In every stock market universe, 80% of companies actually lose money over a long time, and most of them go bankrupt. The only reason you win as a stock index investor is because of this whole idea of the Lotto Model. You're able to capture the 1 or 2 outliers, or the 5 or 10 out of whatever 20 that pay up for everything. Right? That's also the idea of the trend traders, and that's pretty much what all conventional trading gurus teach you, right? So Lotto Model, as I said, small risk, large reward. It's based on, in many ways on the idea of the Pareto principle. The Pareto principle is a philosophy, a mathematical observation done by this Italian mathematician called Pareto, who basically observed that in almost every human activity, 20% of whatever subset of stuff that you were observing were responsible for 80% of all output, right? 20% of all people own 80% of all wealth. 20% of all employees do 80% of all work. 20% of athletes do 80% of wins. Blah blah blah, so on and so forth. It seems to be the very unfair distribution of life in many, many different districts. It's not universal, by the way. Do not, under any circumstances, apply this to some kind of Darwinian view of how the world should be. It's actually, the whole point is, and not to get off topic, but the whole point in many ways is it's precisely because of the Pareto principle that we have to go the exact opposite way and kind of redistribute continuously. Because the Pareto principle basically argues that all wealth eventually goes to very few people, and that creates, obviously, an incredibly untenable society. So same kind of a thing. All profits go effectively to just very, very few people. That's the same principle, and that's where the Lotto model essentially comes in. Now, the insurance model is the exact opposite. And the insurance model is used by dealers, market makers, by high-frequency funds, by counter-trend traders, and by stat arb algos. And the insurance model actually works the exact opposite. It says, hey, I'm perfectly willing to take on big, big risk for very small reward. The classic example of the insurance model in the world is term life insurance, right? Here's $200,000 worth of life coverage for a person of 40 years of age. All he's got to do is pay 74 bucks, right? I think this has got to be per month. I think I would be right to say this per month. So let's just say he's got to pay 740 bucks a year to get $200,000 worth of life insurance, right? And you would say to yourself, holy cow, that is retarded. That is ridiculous. Why would anybody ever be willing to assume so much risk for so little reward? Well, you think it's so little reward, but actually the insurance model is extraordinarily profitable. In fact, the most profitable companies in the world are all insurance companies. In fact, Warren Buffett makes all his money from insurance. Don't be deluded into thinking that Warren Buffett picks stocks for a living. Warren Buffett picks stocks for a living as a secondary, as basically an avocation. His true vocation is making money from insurance. And the reason why is because there are all sorts of contingencies in this particular little contract that make it actually very, very attractive to the insurance company. First of all, you got to pay them money, right? So you got to pay them money to be insured. And when it becomes the age of 41, if you don't pay them money, the money is theirs. So what they're basically insuring you for is they're basically saying, what's the probability that you, as a healthy man of the age of 40, going to die and make me pay $200,000 in that year against a $740 premium? And actually, I noticed because I once kind of railroaded an insurance salesman to find out the odds are ridiculously low. They're like 1 out of 60,000. So 1 out of 60,000 people is going to die. A healthy, normal human being is going to die, and they're going to have to pay it out. So multiply the numbers, you see how much, 60,000 times 1,000 is a huge amount of millions against a $200,000 claim. What looks ridiculous is actually extraordinarily profitable and very, very valuable to insurance companies. So the point being is, it's not that there is one right model. You just have to understand the mechanics of both models to understand how things work. And dealers and market makers pretty much practice the same idea. They'll assume a whole bunch of small risks in return for a large risk. Now, both models actually are the flip sides of the same coin. They basically both converge. If you think about what's the payoff and the losses of both models. In the Lotto model, small loss, small loss, small loss, small loss, boom, win. Win makes up for all the small losses. In the insurance model, small win, small win, small win, small win, small win, loss. Loss wipes out most of the wins, right? The basic underlying assumption is that if you're good at one or the other model, you need to the win has to be bigger than all the losses combined, and the loss has to be smaller than all the wins combined. That's the art of the risk management in both of those models. Okay. Now the negative of the Lotto model, and one of the reasons why I really, really don't like it, and I never trade it, is that you may never hit the winning ticket, right? Remember, the Lotto model depends in effectively on the law of large numbers. You got to place a ton of bets to find that one winning bet, right? Now, when you're buying the stock indices, right? When you're buying the stock market index, that's an easy bet because in one single transaction, when you buy an ETF, when you buy the ASX 200 or when you buy the S&P 500, you're buying in one little transaction 500 little bets, right? 500 bets on all these various companies, that makes it easy. But if you were to do this on a trading basis, you'd have to make 500 trades to find that 1 or 2 trades that's gonna pay out and make up for all the losses. So the Lotto model has the danger of becoming a death by 1,000 cuts, right? Now the negative of the insurance model, pretty obvious. I think this is a picture of Hurricane Andrew. Hurricane Andrew was one of the worst hurricanes to hit Florida. Do you guys I'm actually curious, Fabian. Do you guys call hurricanes cyclones in Australia, or is that are they different than hurricanes?
Yeah, we call it cyclone. I believe they're the same, but yeah, we call them cyclones.
Anyways, they're weather patterns that just do massive amount of destruction. You can see over here, this is actually 3 freaking hurricanes just destroying the peninsula of Florida, right? And that is the negative part of the insurance model. The negative part of the insurance model is that you sell life insurance to 60,000 people, thinking, hey, normal times nobody's going to die. Boom, a hurricane happens, and 1,000 people die instead of 1 out of 60,000 people. Maybe 6,000 people die. Not to be morbid, but I'm just trying to make a point here that parabolic losses is of course the very very serious danger of the insurance model, and its very close cousin, which I guarantee everybody in the room has done, right? So I just want to stop right here in front of our lesson number 1 and see if you guys have any questions, any clarifications you need on the difference between the Lotto model and the insurance model or anything else under the sun before I get into the beauty of the martingale. Tell me, Fabian, does anybody have any questions?
Looks all clear for the moment, Boris.
Okay, super. So the insurance model is very closely related to the martingale model. I'm going to show you how one is a loser and one is a winner and what makes the insurance model different from the martingale model. But I think a lot of people conflate the two, so it's extremely important. In fact, this is probably the single most important thing I did in the whole webinar. And I ask you as an exercise, I don't know if it'll help you much, but it helped me, to kind of do the exact same thing I did in this particular presentation, because I think everybody needs to put their hand on a hot stove and keep it there for a minute to make sure that they really, 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 really burn their hand, and so that memory stays in their mind forever. Because what I'm about to show you is how to burn your hand good. So, Danger of Martingale. This is the classic martingale system, right? You're doing counter trend trading. Price is rising. You sell over here, sell double the amount of here, sell double the amount here, sell double the amount here. You get, it works. It drops down. Boom. You cover everything. You cover everything at a price point higher than the one you started at, and boom, you become profitable, right? Everybody should be familiar with the martingale strategy. And by the way, I'm happy to. I will make the slides available to you guys. So of course, all of this will be available in a PDF. I'll send it over to Natalie, and I'm sure she'll email it to you once we do the recording. But anyways, that's the classic martingale layout. So let's run a little mental exercise, because this is the single most important mental exercise I think anybody can do. Even if you're totally familiar with this, even if you say, Boris, I know what you're going to tell me. I've heard this 1,000 times. Hearing it is not the same thing as seeing it, and I really want you to see it, because I had to see it for myself. I mean, trust me, I've heard this 1,000,000 times myself, but I really needed to see it for myself to fully appreciate the fury and the power of the martingale. So let's make this little thought experiment. We're going to go for a 10 pip target. We have a $10,000 account, and we're going to trade at $1 per pip, meaning that our opening trade, no leverage whatsoever, just 10,000 units, right? Everybody with me? I'm just going to start 10,000 units, zero leverage. I'm not even leveraging at all. I'm just using the cash in my account to open a position of the exact same cash size. All I'm looking for to make is 10 pip target, right? So here we go. Price goes 10 pips against me, right? I now have 10 pips worth of risk. Okay, I double up, right? At the next 10 pip level. Price keeps going against me. Now I have 30 pips of risk. Okay, 10 pips further, I double up again, because I'm just trying to get that 10 pip profit, right? Trying to get back to that 10 pip profit. So now I have on level 3, 30 pips, with movement against me, or 20 pips with movement against me, 10 and then 20. I'm 70 pips in risk. 30 pips movements in risk me, 80 plus 70, I'm 150 pips risk. 160 plus 150, 310. 6 levels down, I'm at 630 pip risk. Remember, each pip is worth $1, and I have $10,000 to my name in my account, right? Bottom line, as you can see, by 7, it's 640 plus 640, I'm at 1,200. By 8, I'm at 2,500. By 9, I'm at 5,000. And by 10, I've blown up my account. In reality, probably with Pepperstone, you probably would be able to hold on to the level 9. But if you were a U.S. customer like I am, that doesn't even have the kind of leverage that you guys have, I'd be blown out probably right around here. You know, in some ways, it would almost be a mercy to have me blow out earlier because I'd probably be able to preserve a little bit more of my capital. But the bottom line is, in this hypothetical, idealistic scenario, just 10 levels against me, I'm blowing out the whole account. So let's understand what I was trying to do. I was trying to win $10. I encountered a one-way move. A one-way move meaning a move that simply went against me for 100 pips without any 10 pip retrace in the process. Never came back 10 pips retracing, you know, for any of my positions. Right? You guys with me? One-way pip of just 100 pips wiped me out. $10,000 account wiped out for trying to make 10 pips. Okay? Now, you say, okay, you know what, Boris? That's retarded. You took on too big a size. Let's do the same exercise, but let's just do a much smaller starting size. Let's do 0.1 lot, the smallest possible lot allowed in MT4, 10 cents per pip, right? Okay, so let's run the same scenario again. I'm going to do the same 10 cents per pip. I'm going to run. So in this particular situation, right, at 10 cents a pip, right, at level 10, I've only lost $1,000, not $10,000, because it's it's 1/10 the size, right? But very quickly, by level 14, I've pretty much blown myself out. That same account is now, this is 16, this is 8,000, right? It's 81,000. This is 16,000. This is already between 13 and 14. I've lost all my money. Okay. I just want to go back and show you. Here, I'm trying to make $10, and 100 points against me, I've lost 10,000. Here, I'm trying to make $1, and 100 points, 130 points against me, I've lost it all. Is that clear to everybody? Somebody type in yes, so Fabian can tell me that you guys have absorbed the monstrosity of how you lose money.
Yeah, we're getting a lot of yeses.
This is not hypothetical. This is not a drill. This, my friends, is exactly what happens to everybody, including yours truly, 1,000 times over. This is not a hypothetical. This is literally your map to failure. This is what happens. This is how people always lose their money. So just, for empirical question, how often does this happen? Well, this is funny. I did this presentation a week ago, right? And it says in pound once every 3 months. So if you guys were trading the pound yesterday or 2 days ago, you saw 6 months ago, boom. We had it wasn't even 6 months ago. 3 months ago, we had a 200 point move. Yesterday we had basically 300 point move, and there were parts of that move. As a matter of fact, there was a move. I don't know if you guys were awake for it, but this was, what the hell was it? It was like 3:30 in the afternoon New York time. Cable went through 128 and through 129. That's 100 points. I'm not exaggerating. I'm not exaggerating. In less than 60 seconds. They just hoovered everything up and down. So if you had an algo that kept selling because you thought 128 was for sure the absolute top in the pound, you would have lost all your money before you could, swallow a cup of coffee. So in the pound especially, this happens, regularly. In the euro, maybe once a year. In dollar yen, if you have big risk aversion moves. The point being is 100 point move is nothing. 140-point move is nothing. What I mean by that is a one-way move is nothing. Which is why you will notice that insurance companies always have a contract, right? It doesn't matter whether you have life insurance, car insurance, health insurance. There's this little word in the insurance business they all use called capitation, which is like kneecapping, if you think about it. I always associate it with the word kneecapping because they're going to cap your knees. What that means in very, very polite legalese is, hey, even if the worst thing happens, we are never paying you more than a very specified amount of money. Our risk is never, ever, ever open-ended. Even if we were unlucky enough to insure you and you were stupid enough to get run over by a car, we're only going to pay you $200,000. We're not going to pay you $2 million. We're not going to pay you $20 million. We're not going to pay you $25 million. And we're going to know exactly how much we're going to be on the block for. So if you think about, to you, the value of your life insurance policy is your asset. To the insurance company, it's their liability. It's their stop loss. So think of yourself as a stop loss to the insurance company. And that's exactly what insurance companies do. So they're willing to assume risk, but up to a very, very absorbable point, right? That's the key thing. They never are stupid enough to offer you a $10 million insurance for $700 worth of annual payments, right? They know the odds. They're not dumb. They capitate. So, Fabian, tell me they all understand the word capitate and they understand what that means. Tell me they understand that their life insurance is the stop loss to the insurance company. That's how they should be thinking about it. Okay.
Yeah, we've got a few people saying yes.
Okay, super. Any questions so far? Anything unclear? Everybody understands the destructive power of the martingale, the very, very important aspect of capitation, and the sort of parabolic, the complete loss of control that happens once you sort of cross this parabolic threshold, right? That's very, very important. And I dwell on this only because I know, even though all of you deny this, in your heart of hearts, we've all done it. Okay, I've certainly done it. I've blown up more than a few accounts following this particular model in its, in all of its glory. I'll even show you what I did today. So this is the single most common behavior, and you really just need, if nothing else, I really hope to make you aware of this behavior, so that you're at least cognizant of what you're doing wrong. All right. So, how would we apply both the Lotto model or the insurance model into the FX business? Well, there's a lot of different ways, but this is my own suggestion because it has to do with a couple of things. Limiting, capitating your risk, and at the same time also harvesting your return. So the Lotto model is all about as we say in America, have a hunch, bet a bunch, right? Meaning, hey, I think Marie Le Pen is gonna really surprise in the French election. I'm gonna just park the bus or back up the truck, as we say, and make a massive short bet on the euro. Coming up on Friday. And if I'm right, I'm going to get a massive payoff. So one way to do this is, first of all, and this is very, very important, you subdivide your capital. You only drop, let's say you have $10,000 worth of trading capital. You never, ever, ever put $10,000 into your broker's account all at once. If you're trading Lotto model, okay? Again, I just, I don't want Pepperstone to get mad at me, but this is only if you're trading a Lotto model. You drop small amount of money, and you make that one deposit, one bet per event risk type of a thing using high leverage. You win, right? The first thing you do, this is the other thing that everybody always forgets, is take the money back. I'm sorry, guys. You're hearing the beeping because I have my FX book up and I guess we have what time is it? That's 8 o'clock. Oh, it's only 8 o'clock. I don't know. For some reason, some news must be coming out. The most important thing is to take the money back. If you've won more than what you've deposited, take that money out because it's just like Las Vegas. If you keep the money on the table, it will just go away. It will just go away. The single hardest thing, the single easiest thing everybody does is they leave the money on the table instead of putting it back in the bank, right? With the insurance model, you do the exact opposite. You need to drop a lot of money because you got to absorb a lot of risk. You trade very, very small. Every time you make profits, you're going to make a lot more profits, much quicker. You're going to make profits. You're almost going to make profits almost all the time. All the time you're going to make profits, but they're going to be tiny. And you're going to harvest them. You're going to make sure that you capitate. That means your max loss, the maximum amount of money you are willing to lose, should never be more than 10 times the win. More on this important point a little bit later. Do not let me forget this. This is the single most important point I want to tell you about risk control. But maximum loss should never be about 10 times length, right? And then as you build up your winnings, again, sweep it back to your bank. Sweep it back to your bank, not by the bank, I mean your bank account, okay? So you can trade both. There's no, I don't have a religious preference on this, but you got to know how to trade both properly. But ultimately, the secret to FX, in my opinion, is a very, very simple, very seemingly mundane trick, and it's this. I promise you, I can't make you profitable. I would love to. I hope to. I hope you guys come join me in BK, and I'll show you, how we trade. But I can absolutely guarantee you that I can make you a much better trader without any strategy advice whatsoever, without changing your strategy, without trying to fix whatever it is that you're doing, by doing this one simple thing. I can do this one simple thing, and I guarantee you I will change your chance of success, and that's reducing your size. Now you may say, yeah, that's obvious. Of course, you want to trade small size, but I'm going to show you what I mean, and it's going to shock you what I mean by reducing your size. Because everything you think about of what you think is normal size is ridiculously oversized. You're all oversized, if there's such a word. But before we get to that, let's analyze the difference between leverage and size, right? I think a lot of people get very confused. People say, I have 400 to 1 leverage at Pepperstone. Yes, you do. Leverage is the maximum amount of credit the broker gives you. You drop $10,000, you can trade $400,000 worth of Eurodollar at any given time. Pepperstone lets you do that. The Pepperstone is offering you a line of credit. You don't own 400,000. This I think is the very, very important point most people miss. You think that this is yours. You own the 400,000. No, you are trading that on credit, my friend. The broker is extending that credit to you. Leverage is simply the amount of credit the broker gives you. So when you say I have 400 to 1 leverage, all you're saying is I can borrow a lot of money. If you say that to yourself, it doesn't sound nearly as attractive as saying I have a lot of leverage, right? What is it Shakespeare said? Neither a borrower nor a lender be, right? So, and I think, Fabian, I'm correct at this, right? Because I'm an American, so I looked this up, but I just want to make sure that I'm correct as far as the numbers go. The maximum leverage that Pepperstone allows is 400 to 1, which is actually 4 million, not 400,000. I completely screwed up. Is that correct, Fabian? It's 400 to 1, so a trader ostensibly could put 10,000 into the account and trade 4 million if he wanted to, right?
Actually, Boris, we offer 500 to 1 on FX.
Oh, 500 to 1. My bad. Okay, so hey, I'm being conservative. Okay, you could trade 5 million to 1. Okay. My whole point to you is don't. Let me explain to you why. So, size is the maximum amount of trade that you choose to put on. So 1 is your ability to trade 5 million. Size is your choice of how much you're going to trade. Let me just stop right there, and please, everybody, tell me you understand the difference between the two. One is just it's just the amount of money you can borrow. Two is the amount of money you actually physically decide to trade yourself, that you decide yourself, right? Everybody clear on that? So size and leverage are not the same thing. Are they all clear on this? I want that singed into their mind's eye.
Yeah, definitely a lot of all clears.
Okay. So, big question of the day. What's the proper trade size? How much should we trade? Now, I'm going to preface this by saying, and I know you're all going to tell me, oh, I'm not like you, Boris. I am a swing trader. I do 1 or 2 trades, a week. I'm a very casual, calm trader. Okay, good for you. I don't believe you, but okay, fine. Even if I believe you, as we say, in New York, mazel tov. Good for you that you do this. If you trade FX and you're honest with yourself, you trade a lot. You trade 5, 10 times a day. I mean, you're not in this webinar to learn how to trade once a month, okay? We all trade a lot. It's the nature of the business. It's the nature of the market. It's a speculative market that moves literally 0.5% a day. If you traded this, if you didn't trade this frequently, why the hell would you want to trade this market? This market is for frequent traders. So everything I'm going to teach you is for people who really are honest with themselves, okay? Be honest with yourself. Nobody in this room trades less than 5 times a day. So this is the formula for you, okay? So don't yell at me if you think that I'm being an idiot and being way too conservative, because I'm addressing the real trader in the room, not the one that that has in his own fictitious mind of how much he thinks he trades. So let's do a little thought experiment again. How many times per day do you trade? Let's do a very nice, clean, round number. I'm going to trade 10 times a day. I'm going to trade a $10,000 account. I'm going to risk 20 pips per trade, right? Very realistic, very normal, very typical day trading parameters. There's a formula here at the end that you can adjust for your own needs. But this is our Joe Boxer trader. What is the proper size on a $10,000 account if I'm following this method? Is it $10,000? Is it $20,000 per trade? Is it $50,000 per trade? Is it 10 to 1 leverage, $100,000 per trade? I mean, that doesn't seem like a lot. 10 to 1 leverage. I can do 5 million. Why can't I do 100,000? Right? The proper risk control method for trading this type of size with this type of frequency with this type of a stop is 5,000 units. Half of your cash per trade. That's what you should be trading. I bet that's what you're all asking me. I bet you're saying I am a complete idiot to suggest this. But hear me out. You're welcome to ignore me, but hear me out. Let me explain to you why. There are 2 ways to achieve leverage. The first way is something that we're all familiar with. It's called credit, right? That's what Pepperstone does. Pepperstone extends credit to us, and that's how we achieve much larger size than we currently possess, right? Another way to achieve leverage that most people don't quite understand and don't even appreciate is called inventory turnover. Those of you who've been in the retail business or those of you who've worked in retail will be very familiar with this term. Turnover achieves leverage with much smaller risk than credit. As a matter of fact, many of you know this company, Zara, right? Many of you may know this gentleman. He is the founder of Zara, Amasio Ortega. He happens to be the richest man in the world. How did he get to be the richest man in the world? By doing this, by doing turnover. All Zara does is stock a little bit of clothes on their shelves and sell them in 1 week, and then stock them more and sell them in 1 week. So instead of stocking 20,000 jeans, they stock 20 jeans and they sell it 1,000 times. Excuse me. So turnover flipping the same thing over 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times is the exact same thing as achieving leverage. Using the exact same amount of money to create a much bigger notional amount of trading than you would otherwise. Is that clear to everybody? Right? So in one example, we have leverage done by credit. In the other example, we have leverage done by turnover. So if we go back to our 10 times per day, $10,000 account, risk 20 pips per trade, why do we have such a small amount of size that we allow ourselves to trade? Because at 10 times per day, at 5,000 units and a 20 pip stop, the maximum amount of money that you can lose is $100, or basically 1% of your $10,000 account. Now, this is the second important rule of the day. Never lose more than 1% in a day. Why does 1% in a day matter? And actually, that is a lesson I learned not from trading, but from engineering. There's like this, I found this really interesting pyramid of costs that they use in engineering. And basically, engineers have this formula that says, hey, it costs 1% to prevent something from breaking. It costs 10% of the project to correct it. And then, if it fails, it's basically the whole project is scrapped. So it's the mathematical version of the an ounce of prevention is worth a pound of cure, right? And if you maintain a 1% stop in a day, you've basically done this. You've prevented the possibility of a very expensive cure, the possibility of correcting too much, too fast, right? Is that clear to everybody?
Yeah, all clear.
Okay. All right. Okay, hold on just 1 second, guys. I'm sorry. Hold on just 1 second. I have to, Fabian, I got to step away for just 1 second. I'm back. So sorry, guys. I'm back. I had to take care of the baby because the nanny was super late today because of bad trades. Sorry, I'm back. Everybody can hear me okay?
Yeah, we're good.
Sorry. Okay, so back to the 1%. 1% is essentially a way to make sure that you never, ever, ever destroy your account. Just want to make sure that's super clear to everybody and that everybody is totally in sync with that particular notion. And this is where we come up with my formula for trade size. It's very simple. It's basically the size of the account, the number of trades you're going to make per day, an average, the typical stop that you have, all of that divided by 100, and that gives you the size of the account that you want to trade. Okay? I want to make sure that I'm going through this very carefully and everybody really understands what I'm just saying. Does anybody have any questions on any of this right now?
Nothing just yet, Boris.
No questions? Okay, super, super. So you say, is this really necessary? Do I really need to trade this small to kind of be risk controlled. Well, let me ask the question then in another way. How much money do you want to make? Right? I think it's very important to ask yourself the expectation that you have of the market. Some of you may say, I want to make 100%. Some of you may say, I want to make 200%. Some of you may want to make 1,000%. How many of you have gotten emails in your email boxes saying, hey, this system makes 1,000% in one day and can make you a trillionaire by tomorrow, blah, 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 right? We all know that's nonsense. But I think in the back of our minds, we still hope, we still pray, we still wish that it's not nonsense. Well, let me show you what having a 100% target means. If you believe that you want to make 100% a year, you must be perfectly willing to lose the 100% a year. In other words, you literally can never, ever, ever make 100% unless you pretty much risk the whole 100% that you have in your hand. It's called symmetry of risk, and it's pretty much an ironclad rule of the market, right? Don't believe me? Let me show you a couple of things. These guys are a lot smarter than you and I combined. This is Renaissance Technologies, Two Sigma Investments of Overbrook and Tepper, who I actually know. These guys have generated between 27 and 30% for like 25, 26 years. These are literally the greatest investors in the history of the world. And that's what they made. That's what they made. And by the way, Tepper, who's made that much money, dropped like 40, 50% of money on certain years when his risk went the other way. So in other words, the whole symmetry of risk story very much plays into the game. So we as small investors have a lot of advantages over these guys. We don't have size, scale, escapabilities. We can, I think, realistically aim for 20% a year because that's within the bounds of reason and history and reality of how markets work. What's 20% per year? That's 2,000 basis points. Each basis point is a 1/100th of 1%. There's about 250 trading days per year. So you need to make 8 basis points per day, or a whopping 8 pips per day. That is not an unattainable target, right? That is really not an unattainable target. That is something that is realistically we can strive for in a decent risk management model. So let's say I have a $10,000 account. Every year I'm going to drop another $5,000 from my savings into this account. I'm going to grow it for 20 years. I'm going to try and make 20%. This is how you become a millionaire, right? You don't do it by dropping 10,000 and having $1 million by Friday. If you have that attitude, you're guaranteed to have 0 by Friday. But if you have this sort of attitude, it's not inconceivable that if you do a good job and you're staying consistent, that you could make $1.5 million in 20 years on making 8 pips a day, something that is very achievable for a journeyman day trader. And so my risk lesson number 3 is all about expectations. A lot of people like to teach you the idea of trading for a living. I think that's the single biggest lie in the world. I think it's really, really hard to trade for a living. But I think it's really possible to trade for life, meaning that if you can make this an avocation that can yield consistent results like this outside of market risk, then you have a reasonable chance for making the kind of money. Now, having said all of this, back to our risk-reward ratios, I think it's very, very important to appreciate one other non-obvious fact of trading, which is that I think standard risk-reward ratios are complete bunk. Now, this is another thing that many of you may disagree with me with, and I welcome you to prove me wrong, but I challenge you to tell me it's different. The basic underlying assumption is if I make a 5 pip stop, a 10 pip stop, a 15 pip stop, a 20 pip stop, my risk rewards should be the same. In other words, if I am profitable 20% of the time in the 5 pip stop, I'll be profitable 40% of the time at 10 pip stop, and 60% of the time at a 15 pip stop, right? No, you won't. You won't. The reason why is that at a 5 pip stop, you are pretty much guaranteed 95% failure rate. At a 10 pip stop, probably about a 60% failure rate on any trade you take. 15%, maybe about 50. A 20 pip stop is pretty much where you get that more or less favorable edge, where you start to move away from the 50, close to 40, 60, 30, 40. This is not mathematical, but this is empirical. This is just, I simply ask you to take a look at a chart, do 20 samples of a 5 pip stop, and tell me how many of them don't get stopped out on any random chart. Why does that happen? Why is a 5 pip stop so much worse for you than a 20 pip stop? And the reason why is a couple. You have spread, right? Spread itself, even in the best broker like Pepperstone, is going to be at least 20% of the stuff. So if 1 pip spread on a 5 pip basis is 20%. 1 pip spread on a 20 pip basis is 5%. Just the spread itself, the cost of spread, it becomes much less, much more bearable on a wider stop. But also because intraday volatility, right? Market is an auction system. Buyers and sellers buy and sell, buy and sell, buy and sell. And because they buy and sell continuously, going back and forth, the movement, the oscillation of a 5 pip move up and down is almost assured. 10 pip is like 70% assured. And then the wider the oscillation, the less assurance, and therefore the higher the probability of a potential. So what I was basically saying to you, I sort of left the key metric here. Do a 5 pip stop with a 10 pip target, and see how many of those trades hit. Do a 10 pip stop with a 10 pip target, see how many of those trades. See a 10 pip target with a 20 pip stop, and see how many of those trades step. The odds will progressively get more in your favor as you go. It doesn't mean that that randomly that's going to work for you. It just means that the odds are going to get better. You obviously need a system that helps you trade those positions in order to do well, right? So I think generally the rule of thumb, the balance between risk and reward on a day trading basis is somewhere between 1.5 to 2 to 1, meaning that you don't want to risk. I found that you never really want to risk more than 2 to 1. So it means you need to have a 70% break even, or 66.5% break even, 70% winnable rate to really win. That's the maximum you want to take it. But you don't really, if you're going to go for this 1 to 2 on a day trading basis, you're almost assured of failure. It's very, very hard. If you go on a longer term basis where you're willing to risk 100 pips for a 50 pip loss, you may have more success. The longer you go, the better the odds are that you can trade close to a positive risk reward model. But on an intraday basis, it's got to be a negative risk reward model, right? So now I wanted to just kind of stop and show you a couple of things, and show you what I consider to be the really important risk ratios. Not the how much money I bet to, how much money I'm willing to lose, the per trade risk ratios. The much, much more important risk ratios, in my opinion, is how well is your system doing relative to how much money it has lost. This is not my idea. This is an idea from Paul Tudor Jones, who made this very, very simple. And it's a lot of people like to use Sharpe ratios and Sortino ratios and all sorts of complicated math. None of it is necessary. If you want to know if you're a good trader, you only want to ask yourself 2 questions. How much money have I made? How big is my drawdown? How much money have I made? How big is my drawdown? That will reveal more than anything else how well you're doing. This happened to have been a really good account I had, where my drawdown was basically 4 to 1. In a good strategy, the drawdown should be 2 to 1, meaning that if I make 10%, my drawdown should be no more than 5%. If I have that type of structure, it doesn't matter if I'm trading insurance, it doesn't matter if I'm trading lotto, it doesn't matter if I'm trading a combination of both, it doesn't matter if I'm trading 1 to 1 risk reward ratio or 2 to 1 risk reward ratio, 1 to 1 risk ratio on trades. None of that matters. It's the holistic number, the gain to drawdown, that really, really matters of how well you're doing, right? I actually, let me just see if I can take you. So, so very much under the, hey, let's do as I say, not as I do example, I'm going to end this by showing you what not to do. I'm going to end this by showing you just how I broke all of my rules, not completely, which is why I'm still up, but showing you all the mistakes that I made because I really want to sear those points inside your head. We all know what to do that's right. It's avoiding what to do that's wrong that is the difference between winning and losing. So this is my account, right? This is one of my trading accounts. And I'm actually trading this account tiny. I'm actually trading this, it's a $25,000 account. Every single trade is $5,000. So I'm trading it at 1/20th. Excuse me, one fifth my equity, right? And I just started this. In America, the retirement account is called an IRA, right? Which I guess, like, for a lot of Anglo-Saxons has a completely different connotation. But you know, you're allowed to trade your retirement in FX, and I'm trading. I just sort of started this account. I started trading it. As you can see, I was doing very well, right? Just a very nice, smooth draw. As a matter of fact, if you were to just simply look, let me just show you. Let's go from March until Wednesday. And let me show you how the numbers work. Oh, sorry. Sorry. Until Monday. Let's do Monday. Really? Okay, I'm sorry. I'm trying to find the best case scenario because I want to show you the worst case scenario. Okay. Yeah, I think this was correct. Okay, so this is Monday, and you can see that, like, you know, I'm basically trading the month of March and April. I really didn't do anything in March. I didn't start trading. I started trading in April. It started to do really well. As a matter of fact, the way to do this, let me show you the extreme case. I'm giving you the let me show you. It's from April 1. The first 2 weeks of April when I started trading this pretty seriously, trading it to my rules, right? You can see that I had essentially a more or less even. You know, I had a 0.4% gain against the 0.4% drawdown. It was 1-to-1, not great, but not bad. You know, not horrendous, right? Not horrendous. And I was trading it very well. Last night, I decided to do something incredibly stupid. I started to oh, sorry. I'm gonna show you from the beginning, but I want to show you what I did that was so horrible. The only difference is that I stopped myself from the insanity. So let's go to the history of my trades. So look at this. Look what I just did. You see this? This was the Kiwi dollar. Yesterday we had the Kiwi CPI. And I allowed my algo to get into this trade. And instead of just letting go to trade, I got stubborn with the trade. And I kept adding to this trade. Now, the only salving grace of this whole fiasco of last night is that I added small. I have a per trade size that's small. So no matter how stupid I was, I did not damage myself. And I cut myself at much less than 1% per day, you know, and I just got myself out of it, and I'm going to rebuild it. But all of this goes to the very key idea of exactly how we lose money. We don't lose money because we make bad trades. We lose money because we stay in bad trades, and we continue to fight those bad trades. So this is Martingale writ large, and, you know, in a continuous format. It's, you know, it's the same BS that all of us do continuously. So the key thing to sort of take away from all of this is that it's not making bad trades that hurts you. It's keeping bad trades on that hurts you. And most importantly is how fast can you recover from this? This was a stupid move on my part. Now it's my rule of thumb is I want to recover from any loss within 1 day. This is going to take me probably a week to recover before I recover back to fresh equity highs on this thing. Utterly unnecessary, just completely stupid. Basically, every time you're fighting the market and you're adding to a losing trade, you are making it more difficult for yourself to recover. I think that's sort of the most important thing you want to take away from what I want to teach you today, is that you will never win. You may win today, you may win tomorrow, but you will never win in the long run. You have to think in generalities, even if the particulars favor you, because you will never win if you keep adding to a bad trade for no particular reason. You will just simply make it more difficult to recover back to fresh equity highs, right? So we all make those mistakes. The key difference of why I didn't even come close to hurting this account was because my size was small, and and eventually the insanity stopped. But I also wanted to show you something else here. I wanted to show you, this is an account that probably a lot of people, I think this guy's an Aussie. He's very famous. He has his account available for everybody to see. And this is an account that, he's got 200,000 in the account. And this is an account that runs essentially like an insurance business. He lets his profits, he lets his losses float. He doesn't use any stop losses, right? Which is okay. But what I wanted to show you, what I wanted to make you understand is, first of all, never look at this number. Whenever you're looking at the actual returns, look at this number, the absolute gain, the real amount of money you made. How much money did you make versus the real amount of money you drew down? This is not something I would like. I mean, for him, it's okay. For me, this is not a ratio I like, right? More importantly, when you look at the account right now, it looks like he's made 200,000 Aussies, but when you look down, he's actually $90,000 of floating losses. Now, maybe all those losses will disappear, and he's going to get lucky, and the market's going to come back, and so on and so forth, But maybe not, As we say in New York, if my aunt had balls, she'd be my uncle. The point being is that if you're trading the insurance model, you need to be very much aware that the difference between these two lines, the growth of the account and the actual value of the account, sometimes can go this way, right? You're always hoping that it's going to catch up to the growth value, but very often can go this way. So always keep your eye on the gain and the drawdown. And to this guy's credit, he's not going to let these things float forever. If they get out of control, he's just going to cut them he's going to cut the losses. But as he cuts the losses, he's going to see a bigger drawdown into his ratio. So ultimately, the lesson of risk is you're gonna lose money sometime. You might as well make it sooner than quicker. You might as well cut the pain sooner than quicker, and then work on getting it back instead of work on hoping that it comes back. Right? That's really sort of the essence of my risk lesson that I wanted to leave you guys with. So, the true measure of good risk reward, of course, as I already said to you, is aim for 2 to 1. Now, one final thing, we just have 1 minute, and then I'll leave time for questions. One final thing that I kind of wanted to leave you guys with: when you are doing badly, like right now, I did badly, right? What you should be doing is, instead of beating yourself up, instead of saying what kind of an idiot I am, why did I want to lose all that money? You need to come back and gain confidence. The most important thing in the marketplace, the most important thing for you as a trader, is actually not your strategy, but your confidence. Your confidence is everything. And the way you get confidence after a series of stupid losses is not by trying to get everything back in one fell swoop. It's making peace with the fact that it's going to take you a long time, and more importantly, by just making positive trades, right? If you notice, the first thing I started doing, let me go back to my account, is just making positive trades. I just started banging, started putting on, wait, hold on a second. Where's my history? So after this fiasco, I just started putting on positive trades. I banged the euro trade, I banged another euro trade. I have a yen trade that I'm floating. I have a pound trade that I'm floating that I'm going to try and close out. It's just a matter of getting small positive trades continuously. Doing that is what regains your confidence, and then you can slowly rebuild. I probably will rebuild this by, well, I don't want to brag, but no, I'm not going to promise. Realistically, I'm not going to rebuild this until probably next Tuesday. Completely stupid waste of time. I basically wasted this week by doing this, but that's okay. That is the whole point. The whole point is that if you're looking for 20% a year, you will have weeks like this. Sometimes you'll have months like this where you're an idiot. You can still overcome it all and still achieve your end year goal by just keeping your size small and by being very good to yourself, by just not beating yourself up and going for small profits to recapture the recovery rate. But the most important thing is if you can stay to a one-day recovery rate in your trading, that's when you become a super great trader. So I'll stop right now, and I'll leave the floor open for questions and see if anybody has any questions. Go ahead, David.
Hi, Boris. We've got just a few questions. So just to start off in terms of leverage settings, I've got a lot of questions about would you recommend traders using a higher leverage for most circumstances or depending on different factors?
Okay, so let me go back because it's exactly what I was trying to, let me go back to this slide. It's exactly what I was trying to make sure that everybody understands. It doesn't matter. You can set the leverage to 1,000,000 to 1. Setting the leverage to a high value doesn't mean you're using it. I don't care what your leverage ratio is. Set it to the highest possible. Of course, you want to set it to the highest possible. What do you care? You want the flexibility. Well, you basically, if you're doing that, you give yourself the biggest loose. The point is, you should never use leverage as a form of risk control. Leverage is simply the amount of money your broker allows to, it gives you, credit gives you. What you're using as your risk control is your size. So the question you should be asking me is, how much should my opening size be? How much of a bet should I be making given the size of my account and given the amount of bets I'm going to be making today? And that is answered by this formula, right? Let me get to it. Size of the account, number of trades, times stop and pips divided by 100. That's the question you should be answering. Okay, go ahead, next one.
Thanks, Boris. Now, in terms of the length of trading, a lot of traders are asking questions about carry trades and obviously swing trading. Do you prefer to keep your trades sort of intraday or risking that 1% a day, or how do you sort of manage those longer term trades?
Yeah, I trade intraday. I like to have a clean account. I don't hold long-term positions. Those of you, I generally recommend a very, very important psychological division. If you have one account where you're going to hold trades for a long time, where you're effectively an investor, then you have an investor account. With Pepperstone, it's extremely easy to open a second account, right? It's like a click of a button. So you open a second account, that's your investor account. You hold trades there for a long time. You have much larger stops. This formula applies in a very different format because your stops are much larger, so your size can be much different. All those things apply. Your day trading account is your day trading account. There, you use your typically in a day trading account, you're going to trade between 5 and 10 times a day, and typically, I don't care what any of you guys tell me, prove to me that you trade like once a week. I'd love to see your accounts. Most of you who are in the room with me are trading 5, 6, 7, 10, 20, 30, 40 times a day. This is who I'm talking to. These are the guys that if you want to survive and thrive and succeed and compete, this is for you. This is what you need to do to be able to control your worst instincts. Like I can try to do a very bad job today of controlling mine. Is that clear?
Yeah, thank you, Boris. Next question would be in terms of your own trading style. Do you, or the majority of your trading, is it done by EA or is it done by manually?
So, great question. we have these two great algos, right? That I'm super happy with, Trendy and Choppy. Feel free to to come into our chat room, and we'll be happy to tell you all about them. That I effectively have been trading manually. Like, in other words, we have the algos written, they trade well. I've just been trading them manually because I really, really, really want to feel the price action. I'm not doing it because it's the optimal way of doing it, because I just really, really want to feel the price action to a level of confidence where I'm going to give most of the responsibility to the EA. But an EA, sort of in my view, is a robot assistant. It is not a replacement for you. My EAs are not 24 hours a day. Any EA that's 24 hours a day, well, people will always tell me that I have this EA, it works around the clock and has been making money for the last 10 years. It's like a unicorn. I've never seen a unicorn. I've never seen an EA that works 24 hours around the clock without human supervision that makes money for the last 10 years. Maybe it exists, but once you dig under the hood, it's never the story. So my EA is an execution assistant. It's excellent at encapsulating the logic that I have, executing without me looking over the shoulder every 5 seconds, and doing the thing that it needs to do. That's how I view my EA. It is not by no means a replacement for my market analysis. Next question.
Thanks, Boris. Now, in terms of your trading style, if for whatever reason a trade had managed to get out of hand, you weren't looking at it or you lost track of it, and it was 5, 10, 15% in drawdown, is there ever a point where you would let it run in the hopes of it coming back, or is it always a matter of cutting it as soon as possible?
Was that Bob Dylan song? You either pay your dues to the devil or the Lord. One of the. Yeah. The point being is, you may escape it that one time. You may escape it even the second time. Sometimes you can escape it even 3 times, and then you'll feel like God, and you'll think, "Ha! What does Boris know? He's an idiot. Look at me. I didn't use the stop, and now I'm richer than I was before." And then I guarantee you will lose all your money. I guarantee you. I guarantee you. I've been doing this for so long, and I've seen every single trader who has argued with me about this point be gone from the business. I'm still around. The reason I'm still around is because I've learned the lesson. The sooner you cut, the easier it will be to get it back. Sometimes it's really hard. If you're down 20% in your account, you got to basically say, I've lost my account. Stop trying to get your account back. Think of it this way. My education, my stupidity, click, done, new education, new account, new mental thing. I'm learning a skill here, okay? If you think you are trying to make money and you're 20% down in your account, you're not. You've just learned a skill, okay? Well, one of the things you see in my account, by the way, that I'm super conservative, but I don't necessarily think that you should trade the way I do. But, I don't think I've ever been down more than 5% of my account, That doesn't mean, the same point, I've never been up 50% of my account. There's this whole symmetry of risk and return. But I don't like to be down. So if I don't like to be down, that means I can't be up, You gotta figure out where you want to be. If you're okay with saying, hey, I'm perfectly okay losing half my account, but I really want to gun this thing, and I want to see if I can make 50% this year, great, go for it. But understand that your chances of you having nothing in that account are pretty much like 75%. So if you're staring at a 15% loss and you don't have any good reason for why you want to be in that trade, except the fact that you just hoping for it to come back and rescue you, you have to just decide to yourself, what are you in this for? Are you in this for hope and a prayer, or are you in this for to learn a skill? And if you learn to list a skill, then just pay your tuition to Mr. Market and start clean and fresh. Trust me, you'll feel much, much better, much, much better once you start clean and fresh. So that's my advice.
Thanks, Boris. And that's the end of the questions.
Okay, that's great, guys. I'm sorry I can't stay with you longer because I got to go do a BK webinar now. Those of you guys who want to come hang out with us at BK, of course, go to bkforex.com and just join my chat room. I will actually email this maybe to Fabian. Should I email this to you, the PowerPoints, the PDF?
Yeah, myself or Natalie.
Yeah, I'll email it to both of them, and then when they have the tape already and the recording already, they'll send it out along with the PDF, so you guys can see the formulas, can see the slides, anything else. Hope you guys enjoyed this. I had a lot of fun. As I said, even though this is not the most scintillating topic of conversation, it is the most important one. And I think I'd love to leave you with this little slide. Boy, was this was something I discovered in preparing for this webinar, and I think this is probably the single greatest little piece of advice I'm going to take away with me. And it has nothing to do with trading. As I said, I picked this up from engineering. This is how engineers look at the world, and we should be looking at the world just like engineers. You know, our account is a pyramid, and if we keep it to 1%, we can keep it alive. If we keep it anywhere, below that, it becomes a lot more expensive to fix the pyramid. So I thank you so much for hanging out with me, guys. And I will see you. I'll see you in the future. We'll do more webinars. Thanks again, Fabian. Take care.
Thank you, Boris.